In mid-May 2026, Michael Burry posted a single piece of analysis about an AI company. Within hours, that company's stock had lost $23 billion in market value. Then Burry deleted the post, closed his social media, went completely silent. The man who predicted the 2008 housing crash, who held his short position while his own investors begged him to stop, who sat in losses for 2 years before being proven spectacularly right, just disappeared from public view right after issuing what he called the scene of the bloody car crash, minutes before it happens. So the question everyone on Wall Street is asking right now is simple. What does Michael Burry know about the second half of 2026 that he doesn't want anyone tracking? To understand why this matters, you have to understand what Burry actually did before going silent. In late 2025, Burry officially shut down Scion Asset Management, returned all outside client capital, and deregistered the firm with the SEC. That deregistration is the key move. It means he is no longer legally required to file quarterly 13F disclosures. The 45-day lag that used to show the world what he owned and shorted every quarter, gone. He replaced Scion with a private family office, trading exclusively his own capital. And he replaced his public presence with a paid Substack newsletter called Cassandra Unchained, where he's been laying out his macro thesis in detailed subscriber-only posts. The practical result: Burry can now execute massive short positions, leveraged bets that markets will fall, and no copycat trader will see those positions until long after they've played out. He didn't just go quiet. He engineered a disappearing act, specifically designed to let him operate without anyone watching. His central warning for second half of 2026 is that the artificial intelligence investment frenzy is a direct replay of the 1999 to 2000 dot-com peak, not in general terms, but in specific measurable ways that have only appeared twice in modern market history. The Philadelphia Semiconductor Index, which tracks companies like Nvidia, has surged nearly 70% since late March 2026 alone. Bespoke Investment Group's data shows the index has pushed this far above its 200-day moving average only twice before, July 1995 and March 2000. The exact peak of the dot-com bubble, Burry's specific comparison. Nvidia today is Cisco Systems in March 2000. Cisco was the picks and shovels provider of the internet boom, the company building the infrastructure everyone needed. It peaked at a price-to-earnings multiple over 200x. Then it crashed, and it took over 2 decades to recover its peak price. In 2026, 87% of all venture capital funding is flowing into AI startups. At the height of the dot-com bubble, internet startups captured less than 40% of VC. The numbers are more extreme today than they were in 2000. We are witnessing history. In the stock market, that is not a good thing. Beyond the valuation argument, Burry has identified what he believes is a systemic, legal but misleading accounting practice that is making the biggest tech companies look far more profitable than they actually are. Companies like Microsoft, Alphabet, Meta, and Amazon are spending billions on AI chips and data center hardware. To maximize their reported profits, they're booking those assets with a 6-year useful life, meaning they depreciate the cost slowly. Over 6 years, the physical reality of those chips. 3 years before, they're technologically obsolete. By stretching a 3-year asset over 6 years, these companies are deferring billions of dollars in operating costs, making their current earnings look significantly higher than their true economic reality. Burry estimates this inflates reported profitability by 20 to 30% at some of the largest names in tech. He layers on a second adjustment for stock-based compensation, the massive executive pay packages that most investors ignore because they're labeled non-cash. They are not economically non-cash. When employee stock vests, companies pay real dollars to the IRS in tax withholdings. That cash leaves the business. shareholders get diluted. Burry calls it the tragic algebra of Silicon Valley compensation, and argues that once you account for it correctly, some of the most celebrated AI names in the market are worth less than half their current price. The post that erased $23 billion in a single day targeted Palantir Technologies. Burry called it the next Yahoo, a reference to the company that embodied everything exciting about the internet in 2000 before collapsing 97% from its peak. At 115 times forward earnings, Burry argued Palantir was priced for absolute perfect execution, zero margin for error, zero margin for competition. The competition he flagged, Anthropic. Data from Ramp's March 2026 AI Index shows nearly 1 in 4 enterprise customers are now paying for Anthropic, up from 1 in 25 just a year earlier. Burry's argument: businesses don't want to spend months integrating Palantir's custom AI systems when plug-and-play foundation models get them 90% of the way there at a fraction of the cost. He backed the view with real money. Long-dated put options at the $50 strike price expiring in 2027, giving him short exposure to roughly 5 million Palantir shares. Then he deleted the post, which, if you think about it, is more alarming than if he'd left it up. Here's what separates Burry from a pure doom merchant. While he's shorting the overvalued side of the market, he's simultaneously buying what he calls the whale fall. The image comes from deep ocean biology. When a whale dies and sinks to the ocean floor, it becomes a massive nutrient source for dozens of species that wouldn't otherwise survive. Burry's thesis is that as capital floods out of expensive AI software stocks, it creates exactly that kind of environment for companies that have been completely abandoned in the rush toward tech. Through his private family office, he's been accumulating Adobe, viewing its recent software correction as a massive overreaction, PayPal for deep value and steady cash generation, Lululemon as a contrarian retail play at compressed multiples, and defensive names like Molina Healthcare and SLM Corp for non-cyclical stability. He also issued one final public warning before going dark. This one directed at GameStop investors after Ryan Cohen proposed a leveraged $56 billion acquisition of eBay. Burry's exit statement: never confuse debt for creativity. Michael Burry has been wrong before. He's been early before, sometimes painfully early. And markets can stay irrational far longer than any short position can remain solvent. But the structure of what he's done is worth taking seriously on its own terms. A man who correctly called the largest financial crisis in a generation just restructured his entire operation specifically to hide his positions from public view, right before issuing a terminal bubble warning. Whether you agree with his thesis or not, understanding what he sees is worth your time. If this breakdown was useful, subscribe. I cover these kinds of macro moves every week, with the actual data behind them, before they become mainstream headlines.